Welcome to Real Estate Radio Live, an informative and engaging hour discussing everything you need to know about the world of real estate. Your host, Tom K. Wilson, provides you with insight and guidance from his years of experience as a successful real estate entrepreneur on how to buy, sell, finance, and invest in real estate, and much, much more. Now, here's your host for Real Estate Radio Live, Tom K. Wilson.
Well, thanks so much for tuning in to our Real Estate Radio Live program, your number one source for all of your real estate needs and education. We're broadcasting from the number one business radio station in the San Francisco Bay Area, KDOW AM 1220, the Wall Street Business Network. I'm Tom K. Wilson, your host for the Wednesday edition of at 2 o'clock of Real Estate Radio Live that comes to you daily Monday through Friday at 3, and also on Wednesday and Thursday at 2, along with my co-host Joe Cachera and Laurie Graymont. If you can't make the live show, you can catch your podcast on Real Estate Radio Live and my programs on TomWilsonProperties.com or on iTunes or on YouTube. If you would like to get a weekly economics newsletter, go to TomWilsonProperties.com and sign up for that. You'll get a nice one-page, 2-minute read from an economist, Howard Blum, who also happens to be a good friend of our guest today, Dr. Doug Duncan. Also, if you would like to have a report on how to select the best metro and products to invest in, we always welcome your questions and suggestions for guests or topics for us to discuss. On my segment each week, we're always focused on real estate investing and all of those factors that go along with that. Also, if you'd like some consultation on what to do with your portfolio, we'd be glad to chat with you about that as well. Well, we have with us today a very special guest, Dr. Doug Duncan, Senior Vice President and Chief Economist at Fannie Mae. He's responsible for providing all forecasts and analysis on the economy, housing, and mortgage markets for Fannie Mae. He also oversees corporate strategy and is responsible for strategic research regarding external factors and their potential impact on the company and housing industry. Named one of Bloomberg Businessweek's 50 most powerful people in real estate and one of Inman News' 100 most influential real estate leaders for 2013. Dr. Duncan is Fannie Mae's source for information and analysis on the external business and economic environment and the implications of changes in economic environment to the company's strategy and execution. Prior to being at Fannie Mae, Dr. Duncan was Senior Vice President, Chief Economist at Mortgage Bankers Association for, I believe, 7 years. And I've been very, very fortunate to have known him for a number of years. And he's a really great guy who, from my perspective, has always been tried to be very, very objective and tell it like he sees it. And I know he's a nice addition to Fannie Mae and to all of those there on Capitol Hill. Doug, thank you for being on the program and welcome.
Thanks for having me. Glad to be here.
So, Doug, when you went to Fannie Mae, which I believe was, 07, about the year before, just before the crash happened?
2008, yep. April 2008.
Okay. Why did they bring in someone from outside, you think? Do you think they realized that things were in trouble and they needed someone maybe with new thinking, someone outside the box to help them re-steer the ship?
Well, their previous chief economist had departed. I'm not certain of the entire search process, but I think in deciding that I would be the candidate that they would eventually go with, I think one factor may have been that in working with the Mortgage Bankers Association, I'd been focused on primary market issues, and of course Fannie Mae is a secondary market agency. And so I could perhaps bring a different perspective that they hadn't had before, given my experience. Clearly, they knew that the market was in difficulty. Just a couple days before I joined the company, they did the last private capital raise that either GSE did. I think they raised about $7 billion in a public offering that was in early April 2008. And then Freddie Mac chose not to go for a public offering. That there was some discussion of that, and then obviously subsequently in September, then as the stock prices continued to fall, and they ultimately were taken into conservatorship. So they're clearly aware that the fundamentals of the market were deteriorating at that point.
Mm-hmm. Have they pretty much given you free rein there to tell it as you see it?
Yes, there's never been any censorship of anything that I said. In fact, that was part of my conversation. Taking the position was offered on their side that they would expect me to be perhaps the most independent voice within the company. Obviously, there are corporate rules because we report under the SEC. There are things that have to comply with reporting rules, and also within the company we have scheduled issuances that we have to meet to maintain the integrity of the company's financial markets, or financial statements. But that does not mean that the elements of the forecast itself are impacted by that. Those are simply timing and ways of delivering the information. So I've never had anyone tell me, for example, we want you to change your origination estimates or your sales estimates. That has certainly never been an issue, and I appreciate the company's living up to its statement that they wanted me to be an independent voice.
I know in our discussions in the past you've told me that, and I wanted listeners to hear it from you. I think it's pretty easy for folks to assume that most anything coming out of Capitol Hill has been steered a certain way, and certainly has not been your experience in Fannie Mae.
No, that's absolutely true. I get teased once in a while about being an optimist or a pessimist, but the bottom, it depends on who's talking. But the bottom line is what they're paying me for is to forecast what I believe will happen, not what I want to happen or what someone else wants to happen.
Now, when you invited Howard Blum and myself back 3 or so years ago, and I invited Bruce Norris and Sean O'Toole to come along, at that time, I recall that the word was kind of already out that it was felt that Fannie Mae ought to be scaled down and eliminated, and everyone there was assuming that just a matter of time as to how long their position would be there, and it was supposed to, I think, shrink 10% a year or so. So some time has gone by since then. What's happening with scale down? Do you think it should happen? Will it happen? Talk to us about that.
It is happening in a couple of ways. One is our portfolio is being scaled down according to law, which requires us to get down to $250 billion by 2018. So we are on progress to not only to meet but to exceed that. In that FHFA has asked us to accelerate that to some degree. So with regard to the portfolio, that is clearly underway and it's on track. It's also the case that in order to attempt to facilitate greater private market participation in the securitization process, we are undertaking some programs which are called credit risk transfer, where we're selling out of the portfolio components of our business which would have private parties take on or share risk with us. So in that sense, we're also scaling down the risk-taking aspect of the company. So it's proceeding according to plan at this point, and I think that will ultimately be healthy for the market.
So you think it's a good thing?
I do. I don't think anyone who believes in the functioning of markets thinks that the fact that Fannie, Freddie, and FHA are 90% of the market believes that is really a long-run healthy circumstance.
Mm-hmm. What percent of the loans are being backed now by Fannie, Freddie, FHA?
It's Somewhere in the 85 to 90% range, since there's not a single location of measuring that from a governmental perspective. That's kind of the prevailing view.
And pre-crash, what was the percent?
Oh, it would have been quite a bit lower than that. More than 50% when you added Fannie, Freddie, and FHA together, but not much more than 50%.
Okay. Now, at Bruce Norris's wonderful I Survive charity event that you and I just went to recently, if I remember correctly, when you were on the panel, I think you brought up the topic of the 30-year fixed loan, that was a bit of a political football, and that politicians probably feel that the borrower's clientele want to still have that product, even though it's very uncommon worldwide, and that the private sector is not likely to support that. And if it's wanted, they're going to have some probably government backing for it to exist. Can you talk about that a little bit?
I'm sure, and I do appreciate being invited to Bruce's event. That's a special event.
That's a world-class event, isn't it? And you
really
certainly get exposure to a lot of them. And
yeah, it's a privilege to participate in for excellent causes as well. I think one of the decisions in thinking about the restructuring of the secondary market or the reform of the secondary market, the decision has to be made whether or not the structures should be in place to support a 30-year fixed-rate mortgage, which is today that's 15 and 30-year fixed-rate mortgages are probably 90% of what's being originated. And I think the consensus in Washington is that is something that the public wants, and that the political world will seek to accommodate. In order to do that, certain structures have to exist that enable lenders to make a commitment to deliver mortgages in certain volumes at some date in the future. And in the absence of the legal structure, of which the GSEs today are a major component and FHA is another, that it would likely not exist because, as you mentioned, it simply doesn't exist elsewhere around the world except actually in Denmark. The rest of the world thinks of a fixed-rate mortgage as interest rates being fixed for 2 years and then adjusting subsequently. So
Denmark's the only other place where you find that.
That's correct. And they actually have a slightly different mechanism where they issue a single bond which backs each mortgage, and then the borrower can buy it back at par if rates go in their direction. So it operates a little bit differently, but it has a long-term fixed-rate structure.
Well, we have with us today Dr. Doug Duncan, Chief Economist of Fannie Mae, and prior Chief Economist at Mortgage Bankers Association. We'll be back with him in just a few moments to chat about the economy. Stay with us on KDOW 1220 AM, the Wall Street Business Network.
For more information on today's program, visit RERadiolive.com. That's RERadiolive.com. Welcome back to Real Estate Radio Live, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RERadiolive.com. That's RERadiolive.com. Again, your host for today's edition of Real Estate Radio Live, Tom K. Wilson.
Thanks for being with us today. We have a special guest, Dr. Doug Duncan, Chief Economist of Fannie Mae, on with us today, talking about not only Fannie Mae, but how the economy is shaping up and the influences that the government has on it. We were talking just before the break about the 30-year fixed loan, and that we're very unique in that product. We've gotten used to it. We've gotten addicted to it. And even though there's pressures to scale down Fannie Mae, Freddie Mac, they may be the type of organization that's needed in order to keep the 30-year fixed loan going. So how is this going to play out, you think, Doug?
Well, it won't surprise me if at some point legislation is passed which extinguishes the names Fannie Mae and Freddie Mac, and it's possible that the structures of the organizations would be rearranged, but and owned in different settings. But the outlines of what is required to support the mechanics of a 30-year fixed-rate mortgage and related securitization will have to look something like the processes of the existing companies. So I think a couple of big questions. One is there a government guarantee of some part of the market, and if so, will it be explicitly and transparently priced? And I think the answer is likely to be yes. Some debate will probably be held over the degree of that insurance and whether it's applied to securities or to institutions. So there's a number of things that the Johnson-Crapo bill raised as progress in thinking through how it should be done. But I think those are a couple of key things, and ultimately I think that will happen.
Well, the bottom line basically is that for the private sector to be the conduit for it, somehow the risk has to be reduced, right? And so there's got to be some kind of guarantee or backing, right?
Yeah, we know that in an extreme event, the government will step in to prevent complete market failure, and so I think the argument is there should be at least some sinking fund or insurance fund against that eventuality, which would give some confidence to investors that there's an end game there and not a complete loss of confidence in the market.
And I survived. I also heard you say that you felt that current soft demand out-trumps tight money. Can you talk about that a minute?
Yeah, we've gone to the Federal Reserve and also to our regulator and others in the policymaking arena and just wanted them to think about the fact that ultimately the housing market is driven by demographics and that there may well have been some residual conservatism among particularly younger households about taking on home ownership until they are well prepared, given what they've observed in the course of the crisis and its impact on housing. So we're very careful about how we make the statement. The statement is today, demand weakness trumps credit tightness. So it doesn't mean that will last forever. We're not sure how long this conservatism will persist. And it doesn't mean that credit's not tighter than it was either. It's just that if you're balancing which are the two are the more important factors today, our view is that today it's that demand weakness. And that's born from a bunch of demographic work that we've done. You may know we do monthly surveys of 1,000 households. Been doing that for over 4 years now. And then we also do special topic surveys. And we've been focusing on young renters, trying to understand a number of things about them and their attitudes toward housing, like does the presence of student debt affect their attitude about their likeliness of being able to qualify for mortgage credit, or does their attitude toward marrying or the timing of marrying has that changed in some way? How do they view renting versus owning? So in that work, we believe we've picked up a strain of conservatism that says they're going to be more prepared than previously.
Okay. We have Dr. Duncan with us, Chief Economist and VP at Fannie Mae, with us today talking about the government's role in our financing of housing and what's happening in general and what they're learning about the current trends and how we deal with it. So we'll be right back with more from Dr. Duncan. This is KDOW 1220 AM, the Wall Street Business Network. Stay with us. We'll be right back.
For more information on today's program, visit RERadiolive.com. That's RERadiolive.com. Welcome back to Real Estate Radio Live, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, Just visit RERadiolive.com. That's RERadiolive.com. Again, your host for today's edition of Real Estate Radio Live, Tom K. Wilson.
Thanks for being with us today with Dr. Doug Duncan, Vice President and Chief Economist at Fannie Mae. Before the break, we were talking about how the marketplace has changed with its maybe a little bit more conservative view of home ownership. Let's talk about that for just a minute, Doug. So percent home ownership has dropped, I believe, from like about 69% down to 64 or so. Is that about right?
Yeah, 64.5 roughly.
And do you do you think this with your studies, which so it's nice, I think, for the listeners to hear that that you are doing these surveys to try to understand what the marketplace is and what direction they're headed, so that and that information helps both private sector as well as government figure out how they address those needs moving forward. Mm-hmm. So what do you feel about home ownership? I believe in the past you've said that you felt personally that percent home ownership indeed got a bit high. What do you think the right amount, or is the right amount should be more reflective of what the trends are? What do you talk to us about renting versus owning trend?
Sure. The homeownership rate peaked at 69% in 2004. It's at about 64.5. A lot of people have stated that the question of whether we're becoming a nation of renters, and my response to that is no. We're simply rebalancing to what demographics and economics would suggest is a more appropriate balance.
And maybe more what the free markets really want in a supply-demand relationship, as opposed to what it became because debt got easy.
That's right, and there was a real policy push to increase home ownership for its own sake. And you can do a little bit of simple math to get to a number that's the 63 to 65% range, maybe, and that is if you think of all the share of the population that's under 25 or say over 75, and then you think about the people that don't want to own a home, you can get to 65% pretty quickly just with that basic set of math. Mm-hmm. So we think that what the market is simply doing is bringing it back into a more healthy, longer-term balance.
Mm-hmm. When you would you throw out a number? I know you've said in the past that when you tell a number, you try not to give a date, and vice versa. And if you get it right, you try not to act surprised, right?
Right. Those are the rules.
Would you? You can tell that struck a chord with me when you first said it, and I love it. I've often quoted you with that. It's nice to know somebody in the government has a sense of humor, right? So.
Yeah. Well, I think the range of 63 to 65% is a reasonable range. To pick a specific number, it's driven by the combination of demographics, where the
Sure.
population groups are, what age they are, and what kind of incomes they have. So
and change in sentiment, right?
And change in sentiment, absolutely. And
Yep.
So right now you've got the boomers within and probably a year of their peak homeownership rate, which for any age group, their homeownership rate actually peaks at about 82% when they're in their mid-60s. So they've been the biggest driver. Following them, you have Gen X, which is significantly lower in terms of population. I think the numbers are around 7 million less, and they were actually the group that took the biggest losses in foreclosure. The millennials coming behind them are actually bigger than the boomers. So
Yep.
You should expect to see that rate move around.
Interesting. Got Dr. Doug Duncan with us today, Chief Economist from Fannie Mae, and we're talking about the economy, government's role in it, and just in general what direction the economy is going. So stay with us. We'll be back talking with Doug more about these factors on KDOW 1220 AM, the Wall Street Business Network.
For more information on today's program, visit RERadiolive.com. That's RERadiolive.com. Welcome back to Real Estate Radio Live, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RERadiolive.com. That's RERadiolive.com. Again, your host for today's edition of Real Estate Radio Live, Tom K. Wilson.
Welcome back. We're honored to have Dr. Doug Duncan with us, Chief Economist of Fannie Mae, on today, talking about the economy, where things are going relative to housing and the government's role in it. Doug, you are for all the real estate investors listening, may be pleased to know that Dr. Duncan is a real estate owner and himself. And Doug, when I invited you out about 6 years ago to speak at our San Jose Real Estate Investors Association, and then I survived after I introduced you to Bruce. I had the impression, and from talking to you, that you went back with maybe slightly different perspective of the investor and maybe the role it plays in our housing economy.
I was, of course, thinking about what was happening with the company's REO pool and spending more time thinking about who all was involved in owning real estate outside of just homeowners. I also had a personal experience where I rented a house from a fellow who bought the house and lived next door, and so I was introduced to the fact that homeowners who maybe have a starting home keep that home and buy another one and become investors. And so I investigated the distribution of rental properties and found that about 30% of all the rental properties in the country are actually single-family detached houses, and most of them are owned by individual or smaller investors. Mm-hmm. And Fannie Mae has some rules around that, and with the growth of our REO portfolio, I thought it would be useful to have some conversations and see if we couldn't find ways to work with private investors to solve problems. And I have a healthy respect for markets. I'm a free market economist, and so I appreciate the decision-making that parties who are putting their own capital at risk make in establishing values. So it's kind of as simple as that.
Now, I was very impressed to see that you were so willing to talk to groups outside the normal circles that you talk to, and clearly listen with an objective ear, and that was very much appreciated. And we certainly enjoyed the interchange with you, and just like your willingness to be on the program today, it's very much appreciated.
Well, I was fortunate when I was working my doctorate at Texas A&M. My major professor, Dr. Penson, at one point when I came to what appeared to be an insurmountable hurdle in my dissertation, said, "Well, Doug," he said, "problems create problem solvers," and I've never forgotten that.
That's great. I will remember that. I like that one. So Doug, I'm sorry. So I got to ask. I can't have you on the program. Everybody will beat me up for not asking it. So what's Doug's crystal ball guess as to what the curve for interest rate and inflation is going to look like moving forward in the next 1 to 5 years?
Sure. We don't expect the Fed to make their first move on rates until next September. I think the consensus in the market is June. We actually think a little later, and we think it's the odds are equally balanced that whether it be later than that or earlier. So we don't actually have much of a change in rates over the course of the next year. And then when they do raise rates, we think the short end of the curve is likely to come up more so than the longer end of the curve. If you look around the globe, there's clearly a slowdown in global growth. The U.S. is the strongest market. We think that our growth will be better next year than this year, but not enough to generate dramatically higher rates by any stretch. We also think the Fed learned their lesson last year when rates ran up rapidly, and that really slowed the housing sector. So they're going to do what they can to make the rate move gradual so that household incomes can keep pace with the growth in real rates, and in that way, housing would make it through in a healthy way. If you're managing risks, you'd have to be aware that we're 6 months past the average length of a post-war economic expansion, so the risks will rise over time that we'll have another recession. So you want to keep that in mind. One of the things that we macroeconomists are not very good at is pinpointing when they will happen.
I know you don't like to give numbers and dates at the same time.
Right, exactly. But you kind of figure sometime in the next 3 or 4 years, we're likely to come into a cyclical downturn.
Have a correction.
Yeah.
So what does that mean? The interest rates will be at in 5 years, maybe up a little, but not very far from where it is now.
Yeah, I would be surprised if they were above their long-term average, certainly since World War II.
What is that, 6?
If you look at the time period from World War II to today, to 2000, the average 30-year fixed-rate mortgage was 6.5%. Mm-hmm. If you take out the high inflation 4 years at the end of the 70s, it's 6%. I don't see us being at 6% for a mortgage rate. Soon after 5 years, maybe. If we see a change of macroeconomic policies that really is focused on growth, we could see an upward movement. But then real incomes would be rising as well. So that would be some offset.
Okay. We only have about a minute left in this segment, but Peter Schiff, whom I'm sure you know of, if not know, in New York, predicted the '08 crash very accurately, and now predicts the U.S. will lose being the reserve currency standard and will default on our loans if we raise interest rates. What do you say to that?
Yeah, I don't see us losing the reserve currency position for quite some time.
Is that because many other world currencies are worse off than we are, economies?
Well, the underlying economies that back those currencies are not nearly as deep or strong as the U.S. economy.
Mm-hmm. Mm-hmm. Okay. So that's so you think that's the main a key mitigating factor?
Yeah, I do. And as I said, I don't see rates rising rapidly and dramatically. I see them rising gradually over time. The chances of the U.S. defaulting on its debt, I think, are very, very slim. You're going to see that the continuing resolution will get passed and the debt ceiling issue will be solved quickly in the next few months.
Mm-hmm. Okay, great. Dr. Doug Duncan with us today, Chief Economist and VP at Fannie Mae, talking very openly with us about where he see things moving forward and how they affect the real estate market. Stay with us, and we'll have some wrap-up items from Dr. Duncan. This is Real Estate Radio Live, and the AM 1220 KDOW. We'll be right back.
For more information on today's program, visit RERadiolive.com. That's RERadiolive.com. Welcome back to Real Estate Radio Live, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RERadiolive.com. That's RERadiolive.com. Again, your host for today's edition of Real Estate Radio Live, Tom K. Wilson.
Dr. Doug Duncan with us today from Fannie Mae, Chief Economist and VP, sharing his views on where things are headed and how they affect real estate. Doug, we just have a couple of minutes left. I'd like to throw 2 or 3 rapid-fire questions at you. You can give us your kind of a brief summary. So, our overall economy, are we going to stagnate like Japan for 10, 20 years and muddle along, or?
We'll be ahead of Japan because we've dealt with our banking system in a much better way than Japan. They simply allowed the banks to carry bad debts forward from period to period. We've required that our banks expunge them and build capital. Mm-hmm.
Mm-hmm. Have we overrated China as the primary influence on shaping our economic position on the world stage?
Well, they've been very important. They have a big problem. That is, they need to rebalance their economy by raising consumption and reducing investment. And what that means is they're going to have to raise wages of their workers, and that will create a comparative advantage shift toward the U.S. So I don't fear them. I feel that they should be a big trading partner down the road.
They might be a little bit larger importer of our products at that point?
I think they would, yeah.
Mm-hmm. Mm-hmm. Interesting. And so that trend may help level the playing field a little bit.
Yeah, that's right.
Okay. So Doug, if you were president, when I read your bio, I don't know, when you hear that, you probably think, gosh, maybe I should have more influence than I really do. Right?
No, but I was raised by parents that instilled humility.
That's all I've seen from you, the years I've had the pleasure of knowing you. So I got to ask you, if you were president and Fed chair, what would you do to protect and incentivize our economy to prosper?
Well, from a Fed perspective, my personal view is a great rate of inflation is 0. 2% means that if your nominal income doesn't increase in 25 years, your income halves in real terms in purchasing power. So I would like to actually lower inflation is better for the economy. And from the regulatory hat, the issue there is capital. It's really those three things to safety and soundness of the banking system. For the president, there's a bunch of things that need to be done. If I was to pick three, I think that great presidents maybe accomplish 3 or 4 things. I think fundamental tax reform is required for the future strength of and flexibility of our economy. Entitlement reform is key. And for the growth and vitality of our economy, I think immigration reform is really important. All of those have significant implications for housing and real estate.
Doug, how can people get more information that's published by yourself and your staff at Fannie Mae?
All the research reports and survey data goes up on fanniemae.com, and it's all publicly available, no cost. And we love to take feedback. We get folks that feed us feedback on it. If you can't find it, just shoot me a note, and I'll connect you up to it.
Doug, thank you so much for being with us. It's been terrific having you on. It's been wonderful having interfaced with you over the years. Thanks very much. And if you'd like to have a newsletter on economics weekly, go to TomWilsonProperties.com, and also some other reports and investor education information as well. We always welcome your questions. Thanks for being with us today. Remember, the only thing that matters is what you do next. Thank you, Doug, for being with us. We appreciate it. This is KDOW 1220 AM.
You've been listening to Real Estate Radio Live. For more information on today's program, visit RERadiolive.com. That's RERadiolive.com. Tune in, log in, download our podcast. Discover more at RERadiolive.com. RERadiolive.com.